Good afternoon. Welcome to CMC Markets on Friday, the 3rd of April 2020, and this non-farm payrolls webinar for March. And I think an awful lot of people have been looking at this particular payrolls report for guidance as to how much damage has been done to the US economy over the course of the past few weeks. Before I get into the guts of the webinar, first and foremost, I have to bring your attention to various risk warnings. You should know that anything that you hear on this webinar should not be construed as trading advice. It's guidance in terms of overall risk management, identifying areas where there is likely to be support and resistance, but I think it's also important to understand that in markets as volatile and as choppy as these, that these areas of support and resistance sometimes can be very, very easy to push through and disappear. So always come with a health warning, always come with a caveat, but it's very, very important that in markets that are choppy as this, and with the sort of economic data that we're seeing out of the global economy, particularly in Europe, particularly in the US, that ultimately you're prepared for significant price swings and potentially being stopped out, because it's more important than ever that you pick your moments to go into the market as well as come out. It's important not only to have a stop loss, but it's also important to have a take profit, because with markets that are swinging 4 or 5% in a day, it's more important than ever that you take your profit, particularly if it's a good one, when you see it, because it may not be there for very long. So with that risk warning put out there, let's get underway. And it's certainly been an interesting few weeks compared to the payrolls report that we saw a month ago. The February payrolls report saw US job gains of 273,000. We're not going to see that today. More importantly, we aren't going to get a clear indication from the March payrolls report of the damage to the US economy. And the reason for that, as was outlined in my morning note, was the fact that the March payrolls report has a cut-off date of the 14th of March, which means that it doesn't take into account the last 2 weeks of weekly jobless claims. So the fact that it doesn't take into account the last 2 weeks of jobless claims means that it's going to be a very limited use in terms of the overall damage to the US labour market, and in particular, the push higher in the unemployment rate. So from that point of view, we will have to wait until next month to find out how many jobs have been lost from the US economy. But to be quite honest, we don't need to wait, because we already know. We've seen in the data over the course of the past couple of weeks that it's going to be bad. The problem we've got at the moment is expectations in financial markets are everything. And even though you and I both know that the labour market, the US economy is probably already in recession, there's always that hope, or hopium, if you like, that it may not be as bad as people think it could be. And a payrolls report that actually comes in slightly better than expected could actually be positive and exert a short squeeze in equity markets when the numbers get released. So let's look at the numbers, because I think that more than anything is important. It's about expectations and what the market is expecting. So let's have a look at the market calendar to get an indication of what the markets are expecting. Now you can argue, these numbers are meaningless, and to a large extent they are pretty meaningless, because they don't really tell us where the US economy is now. They tell us where it was 2 weeks ago. So here's a number, market calendar. You can access it from the news and analysis section on the website, and it's the third item down. So the number here is the minus 100,000 level, which I've set an alert for. So 10 minutes before the numbers come up, I will get a little tab box come up in around about 50 seconds, as it turns out, because it's 13.19, giving me the number and the expectation, as well as the unemployment rate. Now, we've already seen from some of the data that's come out over the past couple of weeks that unemployment in places like Norway and Canada, as well as the rest of Europe, isn't actually showing the underlying unemployment rate as it is. But there was a report out about a week ago that unemployment in Norway jumped to its highest level since World War II in the space of 2 weeks. It'd gone from around about 3% to 10.2 in the space of 2 weeks. That, is the sort of jump that we will probably see replicated pretty much across the entire globe over the course of the next few weeks. And that for more than anything is what markets aren't adequately pricing going forward. So here's the payrolls number. So let's just drag that over here. 100,000. The unemployment rate is expected to push higher to 3.8% in the first 2 weeks of March. And average earnings, we don't care about them, 3%. We used to care about them, but when you're unemployed, average earnings aren't really that important if you've just been furloughed. So it's really all about fiscal stimulus actions from various governments. The Trump administration has already put in around about $2 trillion into the US economy. The likelihood is they're going to have to do an awful lot more. The UK government has done a number which accounts to around about 15% of GDP stimulus package for the private sector to try and tide the UK economy over the course of the next 3 months. And I think that is more important than anything else. If you can keep the UK economy on life support for 2 or 3 months and we're able to come out the other side, then hopefully you should see a modest pickup. You won't see a V-shaped rebound. That is just not going to happen. It's just not going to happen. But I think what will happen is you will see a little bit of a rebound if we're able to come out of this in Q3. It's not going to happen Q1 or Q2. So at the moment, we're getting a little bit of a rebound in equity markets as we come into the numbers. And that's largely on the back of a couple of comments, I think, out of OPEC that we might have a meeting. There's an OPEC Plus meeting on Monday, and we could see a little bit of a rebound in oil prices. We're already seeing that today. That's significant. And I think that is helping to at least stem some of the declines that we're seeing today. So let's have a quick look at some of the key chart levels, because I think that more than anything is what's important, and that's why you're here. You want to know where the key levels are for equity markets as we head into these numbers. So it's instructive, actually, when you look at the FTSE 100, that the rebound that we've seen from the lows of March has managed to stall just before the 38.2 Fibonacci retracement level of the entire down move from the highs that we saw in January. And that for me is a very key level. It's a key level in a number of respects. It's a key level because if you look at the S&P and you look at the DAX, we've seen a similar rebound to similar significant levels. So looking at 5,890, 5,900, that's a key level on the upside. Now, I don't for one moment think we'll probably see that in the short to medium term. But if we actually look at a 4-hour chart, what we can see is if we zoom it down, we can see that there's a nice bit of, you've got declining highs here. Now, that's the worry. We've seen a rebound. We've now come back off that rebound and we've rallied a little bit, come back here, we've rallied it a little bit and we've come back here. So the worry is that if we break below this level here, this is a sign of failing momentum. We could actually see, if we break below 5,300, we could actually see further declines in the FTSE 100, because at the moment what's happening here is we've bounced. This is like a tennis ball. We bounce, we come back, we don't come back to the lows that we saw there. We bounce again, and the subsequent rebound is lower than the previous one. We come back to that support there, we bounce again, that is subsequently lower. So sellers are waiting less and less time before selling the rally. And if we do break this 5,300 area, we could see a significant sell-off as stop losses for long positions get triggered and we push lower back towards the 5,200 level. So that's just a question of market behavior, market psychology. In terms of looking at the way the markets trade, you look at the momentum, you look at where the buyers are coming in, you look at where the sellers are coming in, and you try and extrapolate a move from the price movements. Again, we've got the DAX here, the Germany 30. We've seen the highs here, we've seen the lows here. We've rebounded back to the 38.2% retracement. That's around about 10,200, 10,100. And if we then extrapolate that down further into the 4-hour chart, we can again see a similar sort of scenario playing out. Decent support in and around these lows here, which is around about 9,320, there or thereabouts. The rallies again getting a little bit weaker on any pullbacks. And if we also look at the S&P 500 as well, it's a similar sort of story. And that's what I look for in terms of equity markets. I look for correlations, and they're all fairly well correlated in terms of the rebounds that we've seen. They've all rebounded around about 38% of the entire down move. So if we are going to make further gains in these equity markets, all three of these markets need to push through their upper boundaries. So in the case of the S&P, it's 2650. That's going to be a key level. If we drill down again into the 4-hour chart, we can once again see that we have a key area of support in and around this low here, which is around about 2,430. So if we're going to drift back to 2,430, certainly in terms of a low risk trade, it's potentially worth buying it for a rebound back to 2640. But if we break below this series of lows here, then we then have to rethink our strategy. If we now look at cable and euro dollar, similar sort of story. Dollar's looked fairly strong at the moment. It's certainly pushing euro dollar lower, it's pushing cable lower. If we look at the cable move, we've seen a nice strong down move again, Fibonacci retracements, move to 114. We've recovered back above 122.40, which is 38.2. We found resistance at 50%, which is 125. So if we break below this low here, which is around about 122.40, we could see a number of stop losses triggered and a move back to around about 120, 180. If we're able to hold above that, then we could get a rebound back to 125. It's all about trading ranges in markets like these. You pick your level and then try and trade around that, all the while trying to keep your stop as narrow as possible. Euro dollar, similar sort of story. There's good support of 107.80 on euro dollar. So here, this is the daily chart. We can see that we've come down here, but there is a little bit of resistance in and around these levels here. So that's around about 107.80. So looking at today's lows, that's again 107.80. So there's some decent support in and around this area, which if it holds, should prompt a rebound back to around about 108 or 109. Certainly in terms of a weaker dollar. Dollar yen, just quickly, any questions? Being asked about safe haven status on US dollar. You know, yeah, I mean the unemployment situation is dire in the US, but it's no less dire anywhere else. So really, it's a case of, you know, what's the least ugly, you know. And in terms of safe haven, the US dollar is still king. So irrespective of how bad this data is, it's going to take something quite substantial to undermine the stronger dollar scenario, which we're currently seeing at the moment. With dollar yen, got decent resistance around about the 200-day moving average, which is around about 108.70, 108.80. and then 109.20. But certainly in terms of managing expectations for this number, it's really it's less about this number and more about what's coming down the pipe. The fact of the matter is, next month non-farm payrolls is likely to blow away the March 2009 record, which was minus 663,000. It's going to be in the millions, and we're talking 10, 15 million minus 15 million non-farm payroll number. And that, I think, is more than anything what you need to think about. The economic data is less important than the fiscal response from various governments and the bank and the response from central banks. And I think once the markets are confronted with the reality of millions of unemployed, that could well start to see markets start to melt down. But before I expand on all of that, let's look at the numbers as they break. And here we go. Oh, that's an ugly number. Wow. That is a very ugly number, minus 701,000. The unemployment rate's much worse than expected, jumped to 4.4%. So that is actually very surprising, given the fact that it only accounted for the first 2 weeks of March, and weekly jobless claims very, very low for the first 2 weeks of March. But certainly in terms of where we are, that's pretty negative for stock markets. Let's just quickly bear with me for a second while my system catches up with the pricing. There we go. Yeah, struggling to make any sense of that. Markets don't really know how to react to that, and it's not really surprising because ultimately, while it's worse than expected, it still doesn't fully price in what's coming down the pipe. So at the moment, for me, this payrolls report, I think, is still largely likely to respect the ranges that we've been in over the course of the past week or so. And if you look at where markets are now and where they were a week ago, they're not really that much different to where they were a week ago, despite the dire data that we've seen coming out of Europe. The Italian services PMI at 17.4. I mean, that is just catastrophic. And yet the euro is not particularly weaker on the back of that. The Spanish services PMI coming in at 22.5, again, a really ugly number, and yet not really being reflected in the underlying fundamentals of the equity market. It's difficult to establish what's priced in and what isn't. And I think that is the biggest conundrum that markets are wrestling with at the moment. For me, I'm still very much in a case of sell the rally in terms of equity markets, because I think that's the only thing that you can be. I think when you look at what's coming down the pipe, it's really a question of degree, and in terms of what's the economic outlook going to look like over the course of the next 3 to 6 months. And ultimately, it's either ugly or very ugly. So, on that basis, it's difficult to really extrapolate a scenario that's not likely to result in a lower stock market. The big problem is, how do you get there? And how you get there, for me, is you really have to play the ranges, but with a bias for selling the rally. So at the moment, the market is looking, I think, fairly positive. And if you actually look at what happened with US stock markets over the past 2 weeks, when those weekly jobless claims came in, the market actually went up. I mean, if that's not counterintuitive, I don't really know what is. So, I think at the moment, the premise is that the worse the data, the bigger the fiscal response will have to be from government. So you've got the Trump administration already talking about another stimulus program on the back of the one they've already implemented. And I think that more than anything is what markets are going to react to. They're also going to react to the fact that we've got an OPEC meeting coming over the course on Monday, and we could see a modest cut in production. It's not really going to change the picture for oil demand going forward. That's still going to fall off a cliff. But ultimately, what you're seeing here is the potential for a little bit of a rebound in stock markets, but also a stronger dollar, somewhat perversely, because what you're getting here is that no matter how bad things are in the US, it's likely to be even worse anywhere else. And that is going to push the dollar higher on the back of a safe haven bias. And I think the only way you're going to get any further dollar weakness is once we start to come out of this coronavirus-inspired global lockdown. That will then mean that the US dollar starts to lose its attractiveness as a safe haven. I mean, as I say, I mean, a lot of this is reasoned speculation on my part, guesswork. We've never been through anything like this before. Even when we went through the financial crisis in 2008, we never saw the levels of PMIs that we're seeing today. We're not seeing the levels of unemployment that we're likely to see over the course of the next few weeks and months. These are depression era sorts of numbers. And as a result, it's going to take a while for equity markets to reflect the new economic reality of where we are, but also currency markets. And ultimately, I think when you look at currency markets, it's all about what's the least worst option rather than anything else. And I think in terms of that mindset, that's the way you have to think. You have to detach yourself from the news flow to a certain extent and look at what the price action is doing. So say, for example, I talked about that sterling, that cable level around about 122.40, 122.50 earlier, and talked about that being a potential support level for any dollar move higher and sterling move lower. Let's look at how that reacted in the wake of those numbers and see whether or not we got a move down to that level. And I think you'll find that we actually did. There we go. We got a move lower. We weren't able to take out those previous lows, and we've subsequently rebounded off that area of support. So once again, we identified an area of support around about 122.45.50, there or thereabouts, and we're able to rebound off it. Now the big question is, can we rebound above this area of resistance here around about 123.05, 123.10 for a move higher? At the moment, we're trying to find a level, we're trying to find a range, and trying to establish the next directional move. And with the way the data is coming out at the moment, I think that's a very, very difficult thing to do in the short to medium term. That level looks even more instructive there if we spin it out into a 4-hour chart, and we can see that it also acted as support in and around here, in and around here, and it's still acting as support in and around here. And this is what I generally tend to do when I look at charts. I look for areas where support and resistance, which have acted as support and resistance in the past, and base any trading decisions off those. Because I think in terms of trying to manage a stop loss, if you're buying close to a support or selling close to a resistance, it means your window for a stop loss is much less, it's much more defined in terms of where you leave your stop loss level. So you can narrow it down to 50 or 60 points as opposed to 100 or 150 points going forward. So in answer to, so I'm just going to have a quickly look at some of your questions, because they're coming in thick and fast, and I want to try and answer all of them as much as I can. Okay, so the first question, previous, are support levels generated by algos or sentiment? So that's a good question. Ultimately, I think what support and resistance levels generally are generated by history repeating itself. Generally, what acts as a support and resistance in the past, markets have what I would call muscle memory. And generally, what happens is they can be round numbers, they can be previous highs, previous lows. Essentially, you'll look at a chart and you'll be a market maker and you'll think, I'm going to go long of this at this point. Where should I put my stop? I'll put it below a previous low with the stop loss 20 or 30 points away from that. So generally, support and resistance levels generally tend to be as a result of muscle memory more than anything else. Generally driven by hope, greed, and fear, but also generally history repeating itself. And while you can be quite rightly skeptical about whether technical analysis works or it doesn't, the fact that pretty much every single investment bank, hedge fund, private equity firm uses technical analysis to inform its trading levels and its trading decisions means that even if you're skeptical about it, it still has an awful lot of value in terms of identifying breakout levels, support and resistance levels, but also defining stop losses and take profit levels. Quick question. Do you trade immediately after resistance is broken? How long do you wait to not get stopped out on a rebound? Again, that is something that is defined by experience. Earlier this week, I bought cable at 121.50 on an expectation on 120.50 on an expectation of a move higher. I got stopped out because I got squeezed out on a move back lower before it broke higher. So I took a 50-point loss because I put my stop loss slightly in the wrong place and missed out on the move up to 125. That was really annoying, but ultimately it's not something that I can do an awful lot about. There's no right or wrong answer. Generally, if you're looking to trade a range, I would not be looking to trade the breakouts because they generally tend to be more 50-50. I would generally tend to trade into the resistance with a stop loss above the breakout and then leave it at there. So let's say, for example, 125 is the resistance level. I'd look to sell 124.80, 124.90 with a stop loss at 125.50 for a move back to 123. Trading breakouts generally tends to be the more dangerous way to trade. Yes, it can be lucrative if the breakout happens, but more often than not, you'll get a spike through, it'll rip out all the stops and then it'll come back and you'll be kicking yourself from one end of the room to the other. So I generally tend to trade the range. If you get stopped out on the breakout, it's unfortunate, but hopefully you've traded the range enough to be able to absorb the loss from the breakout. What's going on with gold? Looking at copper and commodities. Yep, I will look at that. Oil. Right. Is market anticipating large-scale social unrest if stagnation continues for months? That is a risk, most definitely. The hope is that it won't last for more than, say, 2 to 3 months. If it does, then there will be a concern about that. That's not something that markets can price in right now. So it's not something that you can price for now. But if, say, for example, we're still in this situation 6 to 8 weeks from now, then it's something that markets might have to start thinking about. Very quickly, what's the lowest you can think cable will be at in the next 3 months? I'm actually not overly skeptical about cable at the moment, simply because I think it will outperform against the euro. So based on that, I think that we've probably seen the lows in cable. The fact that we're able to get back above 120 for me is positive. If we hadn't been able to close the month, if we'd been able to close the month below 120, I'd be much more bearish than I am now. The fact that we're able to recover back above 119.50 is actually a good sign for me. So I think as long as we're able to close and hold above 120, then I think the outlook for cable is largely positive. That's not to say that we can't drift back to around about this 119.85 area here. This red line here on the chart is key for me on cable going forward. If we can hold above that on a long-term basis, then I think there's potential for us to move through 125 and go back to 127.70, because no matter how bad things are for the UK economy, they're likely to be even worse for Europe. and that should hold the pound up against the euro. Whatever the dollar does against the euro, I think again the downside is probably limited to around about 105, 106. Could get worse, but if it does, the pound should benefit from that. But if we break below this 122.40 level on the pound, we can certainly come back down here to around about 119, to around 119.80. But while we're above this support here on the cable between 122.40, then I think there's scope for a bit of a rebound back to around about 125. Okay, let's have a quick talk about oil, because that's pertinent in terms of the commodity currencies. We've just seen WTI at its highest level in over 2 weeks. That should be positive for dollar CAD, and I say positive for Canadian dollar, negative for US dollar. Let's look at Brent, for those of you commodity aficionados. Back above $30 a barrel on the cash contract. Let's just bring that across here. Have a quick look at that. Zoom in. As you can see, I mean, the move we've seen lower in crude oil prices has been absolutely seismic. And at some point, we're going to need to refill this gap. Now, whether or not we can get back to $40 a barrel is moot. But the big question, I think, for me is, will OPEC Plus and OPEC producers be able to sustain a long period of low oil prices at current levels? There's a big problem here that they have. At the moment, the supply overhang is huge. So even if they cut demand, it's probably going to not have that much of a short-term effect on prices overall. I'm looking in terms of crude prices at where we're likely to be, say, for example, over the course of the next few weeks. And the big level for me is yesterday's high, but not only yesterday's high. If we basically zoom all the way out, there's this series of highs through here. So looking at around about $31 a barrel, that's my key level. If we're able to hold below that, then I think there's potential for crude oil prices to drift back down in the short to medium term. I certainly wouldn't want to be buying crude oil prices at these sorts of levels at the moment. Certainly not ahead of the weekend. You also have to factor that in. We've got an OPEC Plus meeting on Monday. I think it's unlikely that anyone is going to want to be carrying any significant short or long position into the weekend, particularly with a meeting on Monday, a webinar meeting on Monday, and the potential for a short squeeze there. So in terms of the upside on crude oil, I'm a little bit skeptical we can see much above where we are at the moment. There's a good barrier all the way through here, around about $31, $32 a barrel. Be certainly keeping an eye on that going forward. WTI, being asked about crude oil, I've still got a target of $1,800 an ounce by year end. If that answers your question. I'm not going to say that we're going to reach record highs on gold prices, simply because I think that's too big a call and it's above the previous record high. So that's putting the cart before the horse. I trade very much on technicals. Do I think we can revisit the record highs for gold prices? Yes, I do think we can. Probably before year end, most definitely. In terms of crude oil prices, we do have to be aware in WTI that we're very, very close to the lows that we saw in 2001, post 9/11. So with that in mind, this $17 a barrel is a huge, huge level. And on a technical basis, certainly I wouldn't be looking to get overly short of crude down at these sorts of levels. But would I be tempted to go long? Not really, not with the sort of price action that we've been seeing over the course of the last few days. I mean, we're seeing 10% moves in a day. How you can run a move in crude oil on that basis, you need to have very, very deep pockets when it comes to your trading, when it comes to your trading book. And we can see that from here. I mean, you look at how far we've come this year alone. Crude prices are down over 60%, 60%. I mean, that is absolutely huge. So you're going to have very deep pockets and a very strong stomach when it comes to risk management if you're looking to trade crude oil prices over the course of the next few days. And I know some of you out there have that, but it's too rich for me. So crude coming back down. What have I missed anything? Being asked about how stochastics help below the graph. The stochastics help in terms of whether a market's overbought or oversold, but obviously you also have to remember that they're an indicator. They're a secondary indicator, not a primary indicator. My primary indicator is price action and trend. So when I look at the slow stochastic, while it will tell me whether something is overbought or oversold, it won't dictate whether or not I choose to buy and sell. It's a secondary indicator, and there are times when I just have to completely ignore it. It's there more for reference than anything else. So yeah, it's one of those indicators. I choose to use it much more on short-term charts than I do on long-term charts. And long-term charts, it's not that much use, but in terms of short-term price movements, it's probably more of a use in terms of momentum indicators on, say, a 5-minute chart, an hourly chart, or a 4-hourly chart. On daily charts, it's about as good as a glass eye on a frosty morning. It's not much use. Right, what else? What other questions do we have? I'm hoping that I've seen all your questions. I'm hoping I haven't missed anything or missed anyone. Copper. Well, copper is very much a demand story. So I think while the global economy is on shutdown, if you're looking for copper to go up, you could be waiting a long time. That's likely to find the upside very, very difficult, certainly in terms of where we are at the moment. Decent resistance all the way through these highs here around about 224, 225. I probably don't have a strong view on it at the moment. It really depends on how strong a rebound we get in Chinese economic activity. But even there, even if we do get a strong rebound, who are they going to export to? Given the fact that Europe, the US and the UK is pretty much on a global lockdown and will be for quite some time to come. So I can't get bullish on copper at these sorts of levels, and we'll be certainly looking for it to head back down towards the 200 level down here. Being asked whether or not, if things get really bad, does freezing the markets to avoid more lost work? No, it doesn't, not really, because all that will happen is when markets rebound, you'll get a rush of people trying to get in or get out of positions that they weren't allowed to get in and out of afterwards. At the moment, financial markets are working. You've got all this liquidity from central banks. You've got 750 billion euros from the ECB. You've got a whole host of Fed stimulus. You've got swap lines from the Federal Reserve. You've got the Bank of England in supporting the markets. Liquidity for markets is not a problem. You've got plenty of that, of liquidity sloshing around in the system. The biggest problem at the moment is the fiscal response, and it looks like now that politicians are starting to step up to the plate. My biggest worry, I think, for financial markets is the European response or an EU response. The elephant in the room is the Spanish and Italian economies, which were already weak leading up to this crisis and whose banking systems are very, very vulnerable. So there is a risk that a fragmented European response could see a loss of confidence in the euro area as a whole. Now, I'm being asked whether or not the dollar could become hyperinflationary with all this fiscal stimulus. Not yet, because at the moment everything's in lockdown. But there is a risk that if the fiscal policy response is not handled correctly as we come out of this, you could see hyperinflation. At the moment, that's not a concern. But going forward, that's something that policymakers do need to be very aware of. Do I see the Dow Jones retouching the lows of 18,200? Good question. Not yet. But that's not to say I wouldn't rule it out. The price action would appear to suggest that that's not a problem at the moment. But if you cast your mind back to what I was talking about with respect to the S&P, the FTSE 100 and the DAX, if we are going to revisit the lows, then I would expect those markets to also start to roll over as well, because they don't just roll over as one, they roll over as a whole. So let's look at a zoomed in version of the Dow. So we can see from this 4-hour chart here that we're in a bit of a range. The bottom of that range can be identified by the low in this chart here, which is around about 20,600. I'm going to draw that in for you so you can see the level that I'm talking about. At the moment, there's decent support through there. So while we're above that, then I think stock markets are still in very much by the dip mode. If we fall through these lows that I've identified in the S&P, the DAX, and the FTSE 100, then the likelihood is we could well go back and retest the lows. But while we're all above them, so you can see these on the chart forums. I've posted updates on the chart forums on the SpreadBet platform. While we're above these key levels of support, then I think it's very much the downside is limited in the short term ahead of the weekend. When I look at the way the markets have behaved, we saw a decent rally last week. We look as if we're going to hold on to most of that rally this week. And then really it's a question of how it all plays out over the course of the next few weeks. And for me, it's all about levels. It's all about what the market does next in relation to support and resistance. And at the moment, if we look at the Dow, 20,600 is the level there. If we look at the S&P 500, and I open that chart again, and bring it back, that's a 5-minute chart. I'm just going to zoom that out to 4 hours. And look at these levels here. So that's going to be 2,430. So a series of lows there, as well as that level there. And then we quickly do the UK 100. Give me a minute. There we go. 5,330. And the DAX. And that's this series of lows through here. And if we go to the chart forums under the news and analysis section here, this gives you an indication. So this is the chart analysis that I've done for the S&P. So I'll click on that. It will open it up and hopefully display it. And there we have it there. So those are the key fib levels that I've identified earlier. And then just drill down into the different time frames, because you'll see all my other trend lines that I put in there as well. How much of these moves are speculator driven? I think they all are. I mean, at the moment, the market is trying to find the weak side of the equation, and at the moment, it's indulging in a bit of probing. You know, where are the buyers? Where are the sellers? How many people want to hang on to risk, and how long do they want to hang on to it for? So, you know, this is basically the market trying to find out where the weak side is. And then drive the market in a particular direction. So an awful lot of it is, I mean, no one wants to sell their portfolios of stocks. This is all about people's pension funds and what have you. So you won't, for the big pension funds, the only time that you're going to want to sell out of a position is if you feel that the global economy is going to hell in a handcart over the course of the next 5 or 10 years. Now, I'm an optimist by nature, and I don't think that's going to happen, because if it does, well, we all might as well pack up and go home. So at the moment, the market is probing for the weak side, and at the moment, there's an awful lot of deep pessimism, and as such, you'll probably find that you could actually go higher first before you go lower. So, will we see new lows on the FTSE 100? Not yet. As I say, it's all about levels for me. And at the moment, while we're above 5,300, then I think the likelihood is we could head higher. And as long as this lockdown doesn't last for more than 3 to 6 months, then the likelihood is in the long term, we will go higher. But it's, as I say, most of it is very much speculation, guesswork. Nobody knows for certain which way this is going to go. Could I cover the 10-year and 30-year bond market? Yep, I'll do my best. Let's look at the 10-year note. The thing with US treasuries at the moment, they still offer a yield. So there's always going to be a certain amount of safe haven bias in there. And certainly if you look at the 10-year prices, that suggests to me that we're going to see further gains in the 10-year, which means yields are going to come down. And it's going to be the same year for the 30-year. And yes, you can argue that the US is going to be issuing an awful lot more debt. The UK is going to be issuing an awful lot more debt. And so are the Europeans. But ultimately, the central banks are probably going to buy most of it anyway. So you'll have all this debt being issued. The Fed will be buying it. The Bank of England will be buying it. The European Central Bank will be buying it. So there'll be ready buyers of this debt. There won't be a lack of buyers for it. So I'm hoping that helps you in terms of the 10-year and 30-year bond markets. There'll be ready demand from debt for debt, and it'll mostly be central banks buying it. Will bond prices drop before any potential high inflation? You'd like to think so, but unfortunately, with central banks being buyers of last resort, it may take a while to show up. I think if you're going to be looking for inflation expectations, you need to be looking at the curve. So you look at the curve between the 2, 5, 10, and 30-year. If you start to see a steepening of that curve, then that could be the first indication that the markets are starting to price in higher inflation going forward. So it won't be so much the prices; it'll be the differentials in the yield curve. So hopefully that helps you in that regard. Being asked about euro yen very, very quickly. I'm going to have to wind this up shortly because I've already run over. By about 15 minutes. But big support in euro yen around about current levels. So I think given the volatility and where we are now, if we do break below the lows that we've seen over the course of the past month, we could well head a bit lower. But in the short term, I'd be a buyer of dips in euro yen with a stop loss below the previous lows. So hopefully that helps you. Right, with gold, here we go. Let's have a quick look at gold because I don't think we've looked at that yet. But with gold, I'm still very much in a case of buy the dips in that. That was a big level, 1450. But looking at these two lows through here, I'd be looking to buy any dips to around about 1580 in the short to medium term for a move back to 1640. 1640 is the next key resistance level on gold prices. Okay, so I'm afraid I'm going to have to wrap this up, ladies and gentlemen. I'm hoping that you gained something from that. It's certainly been an interesting presentation for me, holding it in my home office here down on the south coast of England. Hopefully you took something away from it. If you could leave some positive feedback on Trustpilot or Google or wherever you happen to use it, I would be enormously appreciative. Otherwise, I would like to thank you all for turning up and wish you all a very pleasant weekend and hopefully speak to you all soon. Thanks very much for listening and have a great weekend all.